Good day, everyone. Still your friend IB. Today we shall continue with our cost of capital. In my previous video, I've explained cost of equity and some part of cost of debt. Please go back to the previous video so that you can understand more better. In today's class, we'll be talking about the cost of debt, of which in my previous video I've also explained the traded debt and non-traded debt. I actually started with traded debt, that the debt that can be traded in the market, in the capital market, that the capital market is divided into two, the equity and the debt. So please go back to my previous videos so that you can understand better. Now, in today's class, we shall continue with the cost of debt. I've already equally discussed the preference shares and debenture. Now we'll be talking about the irredeemable debt. What is irredeemable debt? Irredeemable debt are debts that can be redeemed at a particular that cannot be redeemed at a particular period of time. What it means is that these are the debts that their duration is like 30 years, 40 years. For instance, we see government sukuk. So those kind of projects, they are debts that they are long term, right? Their debt cannot be redeemed. It is too long. Do we get? So that is what they call irredeemable debt. Now, irredeemable debt. Redeemable debt. Now, cost of irredeemable debt. So how do we determine the cost of irredeemable debt? The cost of irredeemable debt is equals to the interest, just like the way we did debenture, 1 minus tax rate divided by market value or market price. Some will say is market value, some will say market price. So market value as interest. So I've explained in my previous video, market value as interest means that the interest has actually been paid. Now, this is how to determine the cost of irredeemable debt. Remember at the beginning of cost of capital, I've equally explained that this cost, it is for the firm, while it is a return to the lender, because at the end of the day, the company will pay back to the debtor, that will pay back the interest and principal as and when due, while to the equity holder are expecting it. So they may get, they may not get. So it depends if they actually make profit. So if they make profit, they will get. If they don't make profit, they make a loss, they won't get their return on on investments. Now, another thing we look at is redeemable debt. Redeemable debt. Now, when we talk about redeemable debt are debts that can be redeemed at a particular period. Debt that it has a maturity date, maybe 5 years or 6 years, right? Now, how do we determine the cost of irredeemable debt? Now, when you want to determine the cost of irredeemable debt, you use internal rate of return, internal rate of return to determine the cost of equity, of which we know internal rate of return will get the positive NPV and the negative NPV, right? They will now put the formula. But before then, what are the ingredients? I called it ingredients, sorry. I usually call it ingredients. What are the things you need to watch in your question? Or even in a real life scenario, what are the things you need to look for? So I call it ingredient. Let me equally use it. Three ingredients in cooking. When there is no much ingredient in cooking soup, you can't You can't actually ascertain if that food is going to be sweet or not. So we need to look at some ingredients that can be used, right? What you should look for, right? What you should look for when you actually want to calculate the cost of or what redeemable debt. You use what you should look for are you need market value as interest. Yes, you need market value as interest of irredeemable debt. What do you need again? You need the interest. Of course, this person will pay interest, interest rates. We pay interest and principal, right? This person is going to pay interest, but the interest, there will be a relief. Remember that there will be a tax relief. You want to determine the cost. So we will have tax rate, tax rate, yes. So of course, we have the market value as interest, the interest rate. Of course, we have the numbers of years. Maybe it's 5 years, 6 years, or 7 years. What next? So at the end of the year, you redeemable. We have the redeemable. Redeemables, some will say it is also called nominal value, nominal value, yeah, nominal value. Yeah. So now at year zero, now this market value as interest will be at what? At year zero. This will be at year zero, just like how we are normally do our MPV. This will be at year zero. Now, you are going to pay interest. For instance, if it is 5 years, for instance, you pay interest from year one to year five, right? So for the purpose of this class, let me just use 5 years, right? 5 years. You pay interest from year one to 5 years, right? Right? So numbers of years, for instance, is 5 years, right? So these are the things you need to look for in your question. Market value as interest will be at year zero. You need to determine the positive NPV and negative NPV. So after that, you have your interest, right? You pay interest, there will be a tax relief on it, of course, because you want to determine the cost of irredeemable what? Debt. So interest rate, 1 minus tax rate. If, for instance, you are to pay 9 naira, so there will be a tax relief at the end of the day, the cost to the firm, right? We are calculating cost to the firm. So the interest rate may likely be, at the end of the day, may likely be like 8 naira. You can see that it has reduced from 9 naira to 8 naira. So what is the numbers of years? Okay, it's 5 years. Good. Now we say redeemable, right? Redeemable means, when you borrow money, you pay interest and principal as at the date of maturity, right? So you pay interest from year one to five, while at the last year you pay the interest from year one to five, right? You will now still pay the what? The principal at the end of what? Year five. That is what it means. Let me repeat this part again. You pay interest from year one to five. At that year five, you pay the what? The principal, right? You pay the principal and interest. Remember that the interest has already included in year one to five, right? So that is how to determine these are the ingredients you need